Well, hello and welcome. I am Debbie Hodgkins, and I would like to welcome you to today's webinar, Gold and Silver, How to Trade with Confidence in Sideways Markets. I really enjoy following the work of today's presenter, Tom Denham, EWI Senior Metals Analyst. Tom has been providing market analysis for Elliott Wave International for more than 11 years, covering multiple markets during that time, including metals, European stocks, and currencies. He also taught seminars on trading with the wave principle early on in his career at EWI. Today, Tom is the editor of EWI's Metals Pro service, providing intraday and daily analysis of gold, silver, copper, and other major metals. Tom's 15-year background in psychology helped him to analyze the markets with a deep understanding of human behavior. Welcome, Tom.
Thank you, Debbie. Well, I want you to know that today I'm going to have a three-part presentation. I'm going to give you an overview of my perspective on both gold and silver, starting with the quarterly charts, working down into the intraday charts. That's the first section. Then in the second section, I'm going to talk with you about using a momentum oscillator as a trading system for trading gold on an intraday basis. And then we'll take a break at that point, and I'll turn it over to Debbie, and we will move into a question and answer period. And so I think I can get the overview done in less than 10 minutes. My explanation of trading with the momentum oscillator in a little over 10 minutes, and then we'll take the rest of the time for questions and answers. Now, I like to start with the quarterly chart. It is actually very important to my comfort with a long-term wave count and outlook for gold and for silver. Now, the chart on the right is the bar chart of quarterly gold. On the left is a candlestick chart, also on the quarterly time frame, and this chart includes an ADX study. And I've set it up so that when the study and its directional portion is bullish, then the candles show up as blue, and when the study is bearish, they show up as red. The other information to be aware of on this chart, the thick black line is a representation of the statistical trend. You can see on a quarterly basis, gold was trending very strongly up through the peak, and then it has begun to fall off. I've got a 5-period moving average associated with it as a signal line. Now, the idea is that when the trend is above its signal line, you're in a genuine trend, and when it's below, that trend is falling off. And this study is unrelated to whether the market is rising or falling. Now, back over here to the bar chart. What is important, I think, when I look at this chart is to recognize that the last decline that gold had was from 1980 to 2001. So we had a 21-year decline. And then we had this rally from 2001 to 2011, a 10-year advance. So here we are in 2014, looking at the history of gold. It's a good bet that gold is not finished declining yet. I have no confidence that gold will decline for 21 years like it did from the 1980 peak, but I think that it's very likely that it's got more downside action to develop than we've seen in the past 3 years. And so let me shift over to the monthly chart, and I'm going to change my ADX study over to the monthly time frame. And here you can see the wave count that makes sense. That last 10-year rally was very likely a 5-wave move, 1 and 2, and then wave 3, and you can see 1, 2, 3, 4, 5 of 3. This 33% decline that ended in 2008, and then a 5th wave rally to significant new highs. And you know what the Elliott wave principle tells us: after a 5-wave rally, we should expect a 3-wave decline. And I believe that we are currently in the late stages of developing wave A down. Now, again, we're 3 years into this move, and I'm thinking we've got farther to go on the downside, and then we should have a rebound and then another 5 waves down. The classic target after a 5-wave rally is a retest of the previous 4th wave low. In the case of gold, that means 725.50. Now, this is a big and long-term forecast. One thing I would say to you, I took over the Pro Metal Service in August of 2013, I think. It could have been a little earlier. This is the identical wave count that I've had from that time. This is a count that you can live with for a good long while. So let's move on to the weekly chart and see what's going on there. And I'll move my ADX chart over. And what I think has happened is from that peak we've had a wave 1 down, and then a complex correction as wave 2. We've had a wave 3 fall, and this wave 3 happened to be right at a Fibonacci 1.618 times the length of wave 1, which made it a nicely measured wave 3. And I think that what's happening now is that we're in a triangle correction. And so we have not begun that last wave down that we were looking at on wave A on the monthly chart. We are in actually wave D down. Then I expect to see a rebound in E before a 5th wave begins to fall down to the 1091 area. Now I'll move this on to the daily perspective. And here is our Elliott wave count at the level of the daily chart. Here's that converging triangle correction. We've seen wave A and B and C, and I think wave D remains in progress. We had a quick 3-wave W, a triangle X, and we're in the midst of getting a 3-wave Y down to the downside. Many times in a triangle, you'll see the next leg retrace about a Fibonacci 78.6% of the previous leg. And so my target here with gold is that wave D get down to the 1226 level. This wave count will not be invalidated if price falls through that level. The count remains good while price is above 1181. And so my thought is we've got a little strength here today. We're going to have weakness return, and then we'll have that rebound to the upside. Now, let me show you some of the intraday perspectives that I have on this market. Here's that wave X triangle that just completed the fall. That's probably wave A, rally that's B, and then I'm looking for wave C to the downside. And then to look at this in a little bit more detail on the 240-minute chart, there's that fall, kind of an A, B, C up at this point. And that's probably all that needs discussion at this point. The intraday chart that I'm working with in my intraday updates at the present time is the 60-minute chart. There's a 5-wave, 1, 2, 3, triangle 4, 5th wave thrust down, then A, languishing, long-running, sideways B, and then it looks like wave C remains in progress. So let's shift over to the silver forecast. And let's see, there's my quarterly chart for silver. And you might note, if you remember gold was one straight shot to the upside on the quarterly chart. With the silver chart, you can see that it was broken up. Silver has not been as strong as gold over the last number of years. And looking at the silver chart, again, we had the same 21-year decline from 1980 to 2001, the same 10-year rally. Silver has been weaker than gold. It has retraced where it's approaching a 78.6% retracement level. It is more advanced in its decline, but I think it too has farther to run. Considering that the last decline was 21 years, I think this one we should give it more than this most recent 3 years that we've seen. Moving over to the monthly setup, it's an identical outlook here on the bar chart. We can count a quick 1, 2, 3, 4, 5. Wave 4 retraced 58%. That was that big dip that we saw on the quarterly chart, but we had the fifth wave thrust to a significant new level. One of the things I mentioned is that fifth waves in metals market are often extended. In the stock market, you'll often see wave 3 extending, but it seems in metals markets, commodity markets in general, you will often see the fifth wave is the one that really, really moves to the upside. So I'm thinking that we've got more downside in wave A before we have a wave B rally, and then a wave C sell-off. In the case of silver, we're looking towards the 968 level, the previous fourth wave low, as a potential bottom. Now, I'm looking for this being a number of years out in the future. I didn't talk about the timing on the gold chart, but I'll talk about it here with silver. See, we're in 2014 from a 2011 high. I'm thinking we should work wave A down probably to the end of 2014, and then we might begin to rally in 2015. I would expect that 2015 is likely to be totally consumed by the wave B rally. It could go into 2016, and so somewhere in 2015, 2016 is when I would expect to see that next wave down, and it could easily go 4 or 5 years to take us out to 2019 or even 2020. Now I'm going to move. Oh, I hit the wrong button. It's one of the things analysts do. We hit wrong buttons sometimes. Got that back in perspective. I'm going to move to the weekly chart for you. And, oh, that's the wrong chart. I missed. There's the weekly chart for silver. And let me bring back the ADX chart. Here you can see that I'm counting from that peak back in 2011, a leading diagonal wave 1 down, an ABC rally in 2, then wave 3 and 4, and I'm counting silver is developing an ending diagonal wave 5 down. I would love to have maintained the same converging triangle count and viewing silver is still in wave 4, but in futures, silver came down and made a new low below this previous level. Now in the cash market and in some of the markets that some of our subscribers actually trade, silver had not made a new low yet, but in the futures, which is what I focused my analysis upon, silver has already made a new low, and so I shifted to a similar but different count. The idea with an ending diagonal is that you have a series of 3-wave impulsive waves that actually develop 5, and it is not as likely to go as low as we might see gold, but we should see much lower lows than we've seen so far. I'm thinking maybe down to the 15 level to complete wave A of the decline. And then looking at the daily chart of silver, here's more detail on the daily chart, thinking that wave 4 peaked at 25.29. We had a 3-wave 1, a 3-wave 2, and we're working a sloppy wave 3 down. I'm thinking that silver should exceed at least a Fibonacci 618 of the length of wave 1 as it moves to the downside, and so I'm looking to at least 1834 and potentially a little bit lower before we see a wave 4 rebound, and then after that time I would expect to see wave 5 begin to make downside progress. And then looking at some of the intraday charts to keep this in perspective, the internals of a leading diagonal are sloppy. They're not the pretty 5-wave moves, and so we've seen a lot of choppiness inside here. And I think that choppiness is ongoing, and that we're going to see it reach lower and lower. To look at this on the 240-minute chart, you can see that we're getting A, B, C, W, X, Y, X, A, B, C, maybe another X, and then I'm thinking we're going to see prices selling off to lower levels. The chart that I've been working with on the intraday updates most recently is the 90-minute chart. We had a 5-wave move to the downside, 1, 2, 3, an awkward triangle, 4, 5, and then A, B, and then this moonshot that is, it appears to remain in progress at this time, but I'm thinking that this is a corrective move. We're going to see a peak develop, and that silver will then begin to sell off again. Right now I've got my Elliott wave count focused on the 1892 level as support, and I'm looking up towards Fibonacci levels above us. The 50% retracement level is the upcoming target if price continues to rise. And so if we hit 1922, I'll start looking up towards 1936, the Fibonacci 618 retracement level. But if price weakens and falls to the 1892 level, then I would begin to give up on the upside. I think that we've had our completed decline here, our completed rally, and it's time for another segment to the downside. Now, the choppiness and the quick turns is one of the reasons why I thought it might be useful to talk with you about trading in these quick changing environments with a momentum study. And so I finished part 1 of my presentation, and we're just going to move right on into part 2. And for intraday trading, what I like to use is a momentum oscillator. This is the one by Tushar Chandy in his book from a couple of years ago. I'm using it set on 21 periods with a 13-period exponential moving average as a signal line. And to explain to you how this is set up on the chart so that you can visualize the message from the chart easily, when the momentum oscillator is below its moving average, the candles appear as red. And then when the oscillator is above its moving average, they're blue. And so the basic idea here is that momentum is favoring downside action when these candles are red, and it's favoring upside action when it is blue. And so you could then use this as a way to trade the market. Now, this chart can be used to visualize price action in a variety of time frames. This is the daily chart of gold futures, and there was a decline. This is the first part of wave D down in my converging triangle outlook, and then we had the beginning of the triangle, and I think this is A, B, C, D, and then a wave E triangle, and then we had the drop out of the triangle. Now, the problem with using this momentum oscillator at the level of the daily chart is, look, this was a very substantial rally that the study marked as a bearish segment. Now, it was bearish in the sense that we certainly had a bearish resolution from it, but it wouldn't have been a very useful tool for trading in this market. And you can look at it in a variety of other segments. I'm just scrolling through some of the different time frames. Personally, as I have worked with this study, I have found that I like it best for trading at the 30-minute level. And I want to go back and show you one of the really exciting opportunities that this system could have put you in a very nice way. It's the end of that triangle that we were looking at. Here it is on my Elliott chart, and if I bring back up the daily chart, I want to keep you in mind. I want you to keep in mind what we're looking at here. On the Elliott wave count, we knew by the time we got to the latter stages here that we were in a correction, that it was most likely a triangle. And so we were looking for an end. In my intraday updates at this time, I was saying we're in wave E of a triangle. We're looking up somewhat higher before price reaches an end. And the end of the triangle actually turned out to be 1293.50. We had the E wave of the triangle turned out to be a triangle itself, and then price moved into the sharp decline. And come back up. There we are. This is that point at which we had the market making its peak. Now, the way I like to use this study for trading is to keep it in mind with where we are in the Elliott count. So in the Elliott count, I was looking for the end of a pattern and the beginning of a new pattern, and I was looking for the beginning of a bearish pattern. And so I was looking for a breakdown. And so if I'd been watching this very carefully in real time, here was the end. That was the peaking level. The next candle, I would have ignored that because candles can fluctuate. You can see here as we got to the end, we had 3 bearish candles. That was 90 minutes of a bearish signal, and then we had 1, 2, 3, 4, 5 bullish periods. Then we had a bearish candle and then another bullish candle. What I like to do is wait for the second bearish candle in a row to be my signal that now is a good time to begin speculating on the downside. And so if you'd gotten in on this second bearish signal, you would have had quite a drop with gold futures. Now, just like with the waiting for the second signal to get into a trade, I like to wait for the second signal to get out of a trade, because if I move on the first signal, sometimes that's just a little fluctuation, and then before the period's over, it's gone back to being red again, and I've gotten out maybe prematurely. But if it makes it into the second period and it sustains a positive message for momentum, then I would take that as a good time to get out. Now, to look at this, if we'd gotten in on the second candle and out on the second candle, that would have been 243 ticks, and in one gold futures contract, that's $2,430. That's a pretty good day of trading. Now, this kind of move does not develop every day. It doesn't develop every week. We're lucky if we get a big move like this once per month. But it was a good paycheck there. But it's not realistic that you should expect to see this kind of move on a regular basis. Now, if you can follow, you can see that where I was getting out here was as the Elliott count was reaching its third wave bottom. In fact, it was a little bit before the bottom. It was this little bit of congestion right in this area here. And so there was more downside action available to us, and indeed it was possible that we would have gotten out here, we'd have had a couple more bullish points, and then we started getting bearish again. We might have decided we're going to get back into the bearish trade again. And let's see what would happen if we'd followed this very directly. If we'd gotten back in on the second bearish candle, and then we had a bullish candle and a second bullish candle, we might have got out on that candle just to be safe. 10 ticks, $100 of profit. Not too bad. Better than losing. And then we got a lot more upside action here. And I might have been expecting that we would have a more substantial rebound here, but after a big drop like that, personally, I'm not too excited about getting bullish again, and price made just a little bit more upside action, and then it started getting, it got bearish again. And so, and this is a good opportunity to emphasize using the second signal rather than the first one. We had a whole series of bullish signals, and then we had a bearish signal, and if you got in there, well, the next signal was bullish. That might have frightened you, and when it moved up to a new high, which is what it did, you might have said, oops, and you would have gotten out, and that would have been a losing trade. But if you'd waited for the second signal, well, actually, that was a first signal. That was a new bullish signal, so you would have scratched your previous bearish signal. So here was a bearish signal, but here was a second bearish signal. You might have gotten in during that second bearish signal. And let's say you got in at the close of that second bearish signal. And let's see, oh, I used the wrong tool. Second bearish signal here. We'll grab it, say we got in at that point. We got a bullish signal over here. 42 ticks, $420. Now we didn't know that we were in the middle of a triangle at this point. But looking at this on the Elliott chart, after this decline through here and then the correction out to here, I probably would have been looking for the upside, and I might have thought about taking an upside trade, especially after this drop here. I might have started thinking, okay, I want to get in now. And let's see what would have happened if I'd got in. Well, let's say if I actually decided that I was bullish here and I got in at this point, I would have stayed in, and then I would have had this bearish drop, and that would have scared me, and I'd have just gotten out. I wouldn't have waited for the second signal, and that would have been a $490 loss on the bullish side, $490. Okay, so I'd have said, ooh, this market's not finished yet. I should be bearish again. I might very likely have said, I want to be bearish, and I might have got in on this signal, and then I would have had a bullish signal. It would have been countermanded by a bearish signal, another bearish signal, and then bullish signal. Boom. That's an 8-tick. I was bearish. This was 8 ticks up before I got out. That's an $80 loss. Now that's not too bad, an $80 loss, if I've got some other trades where I'm doing pretty well. But at some point in here, I would have begun to recognize from my Elliott perspective that there was a complex correction going on here. And I probably would have said, you know, today's not a good day. Let me get out of here. And I might have just given up and gone home for the day. But at some point, I was going to get finished. You know, what actually happened is this triangle ended probably about right in, oh, that's where the triangle was ending, right there. And so if I was able to recognize that triangle in real time, and frankly, I don't remember exactly what I was saying about this at the time. I was thinking that we had something complex going on, and I wanted more upside, but we got that triangle. There was a nice move in here, and you could have captured it. Let's see. I probably would have been a little suspicious down through here, but after we rallied and started to come off, I started thinking about it again, and I might have got in on this move. And then if I waited for the second tick on the downside, that was a nice 70 ticks to harvest. Well, now I've talked to you enough that I better get down to real life right now. You remember that this market has moved sideways over the last several days in here. We had the fifth wave bottom, we had a rally, and then we just moved into this awful mess. And this was just difficult. And I kept looking for price to break up in wave C, and we'd have some moves, and then we'd flounder, we'd move and flounder, move and flounder. And there was some news that was coming out today. We knew that we were near a low. I was expecting price to get back down and retest the low. It happened here. Now, the market got bullish in terms of momentum much earlier. It got bullish before the peak. If you got in on the second bullish signal, you would have gotten in before this market rallied. You might have got in here, and you can see that if we'd gotten out at the low, that would be a $300 loss, 30 ticks. But momentum actually has stayed bullish through that period. So if you'd gotten in here and you'd followed the momentum to where it is today, you'd still be in a trade. You'd have 93 ticks at this point, a $930 profit in this market. Now, I'm about to stop telling you things that I have in my presentation and turn it back over to Debbie. I want to say one more point here before I think about it. Sometimes I'll move this chart up and look at it at larger degrees. And when I see that I'm in a segment of price action like this, a lot of times I just say, I don't want to take a chance on this. I'm in a sideways market. There's obviously a correction going on. At some point, there's going to be a breakout, but I don't want to get myself chopped up trying to catch this through here. And so there are times when I'm looking at the market, and I just won't trade at all for days at a time because I don't want to deal with this. I don't have time to deal with this. It's a grind that I don't want to deal with. But when I think that I'm near a bottom, or when I think I'm near a turn, my Elliott pattern is beginning to get to a mature place, that's when I could start looking at this again. Well, now, I've gone almost 30 minutes here. I better stop and let Debbie talk to you, and then we'll take some questions.
Okay, thanks, Tom. Before we get on to the questions, I would like to let everyone know that the webinar today is being recorded, and we'll send you the link as soon as it is available. It will probably be tomorrow. Also, if you're not already a subscriber to Tom's service, you'll receive a free trial offer for Tom's intraday service for 1 week. You'll really enjoy Tom's service. Not only does he offer the written analysis, but he regularly posts short videos at the end of the day in which he offers some perspective to his analysis and gives some pointers about Elliott Wave and trading. They're really great videos, just like today's presentation. It's very clear. He educate you along the way, and they're very helpful. So look for offer details in your inbox soon. Alternately, you can contact EWI customer care to get set up right away with a one week free trial. You can email customercare@elliottwave.com or call a representative at 800-336-1618 or from outside of the U.S. at 770-536-0309. Let's go ahead now and take a few questions. Tom, you have a chart up here that I believe we have a question regarding. Luke asks, in the gold 60-minute chart, your wave 4 triangle ends lower than wave 3. Is that a valid count then? And also, let's see, and what would you call the retracement of that? Could you explain that a little bit further?
Well, you know, 10 years ago when I was teaching Elliott classes, I could have given you an authoritative answer in which I said yes or no to whether you can have a valid textbook fourth wave triangle end below the level of wave 3. The truth of the matter is I don't keep up with the details as sharply as I once did. And I don't know if this is a completely proper, valid triangle now that you raised the question. However, I'm very confident that what we have here is a 5-wave decline. And so I might offer to you that ending the triangle where I have it might be a problem. I need to look that up in the book. Is this a 5-wave move, and was this a correction in this area? I think yes. So is that a scary answer for the Elliott people listening to me? You know, part of what I have to say to you is I spend my life trying to get a profitable perspective on the market, and sometimes I cut some corners because to me my task here is not so much to be correct as it is to be pointing in the right direction, so that if I tell you the market's going down, you're ready for it to go down, and if I'm pointing up, it goes up, so you have an opportunity to make money on the upside. Okay, so hopefully that'll be the only embarrassing question I take.
Okay, I have another question here from James. Can fifth waves extend in bear markets also?
Oh yes, yes they can. You know, the idea with commodity markets is that it takes a while for people to get interested in it, and that also that it's in the fifth wave that fundamental reasons become clear to people, like a shortage, or you know, like with gold or silver, we might have issues like the cost at the mines got so high as the price came down that the mining companies began to shut down mines that were no longer profitable, and then well, actually, that's the opposite of that. That would be a bullish one. But as prices go down, if the supply is good, let's just stop. I can't talk about fundamentals, but I can tell you that, yes, fifth waves sometimes extend to the downside just like they do on the upside. You know, I was joking, well, I got to tell you, I was joking with Debbie earlier about I want to be humble, but I'm actually full of myself. And every once in a while I just have to stop and say, I know about technicals. I'm not really a fundamental guy.
Okay, thanks, Tom. I have a couple questions about your momentum oscillator. First, could you repeat what the name of it was, and then could you explain the settings again?
Yeah, like there's a author named Tushar Chandy. Chandy's his last name. I don't know how to pronounce his first name. And he wrote a book, I think, in 2011 called something to do with technical analysis. In any case, momentum oscillator is the Chandy momentum oscillator appears in a lot of charting packages. It happened to be in my Trade Navigator software. It's kind of a standard thing. There's nothing custom about this. I just happened to set it up with a 21-period oscillator and a 13-period moving average. This could be changed to other, I mean, the default on the momentum oscillator was 14. I frequently, when I'm working with technical studies, I like to use Fibonacci numbers. It's just a habit I have. And I liked 21 better than 13. When I see, what I do is I don't optimize these studies with a computer doing a lot of number crunching. I just change the settings, and then I look at the price action, and I see if it gives me good trends, if it measures the trends nicely at the levels I'm working with. And so I'll play around with it for a few weeks until I feel like I've got settings that work pretty consistently in the market, and then I'll stay with that. And I've been using these settings for several months now, and I've liked what I've been able to do with it. One of the reasons I use this particular study is because you can visualize when momentum is at a low level, and you can visualize when it's a high level. Some traders are interested, you know, they'll talk about a market is overbought when it gets to plus 50 or oversold when it's at minus 50, and so they'll think about buying when it gets at minus 50 or selling when it gets to plus 50. That's one way that this oscillator is used. I prefer to work with a signal line to let me know when momentum is shifting from the bearish side to the bullish side, and then I compare where I am in an Elliott perspective on the market, because there are times when I know I'm in a triangle and I'm just not as excited about what I'm dealing with, especially if it's a small triangle, or, you know, as this sideways action drug on, I just didn't want to take action. I just wanted to watch until we were at a place where there might be a swift move. And frankly, I might not have been bullish back here at this point. In fact, I probably would not have. I would have been suspicious. I'd have waited for this drop here, and then I've seen this come back up, and if I was really, really lucky and I was having a good day, I might have got in near the close of this candle and the beginning of this candle so that I would have caught that rise. If I had missed and I'd seen this rise here, I probably wouldn't be in this trade. But that's the problem with being an analyst and not a trader. When you're a trader, you keep focused on the real potential, and when you're an analyst, you go off to get a cup of coffee just as the trade goes on. Okay, was that a full enough discussion of the question, Debbie?
I think so.
Okay.
Let's try another one on your okay. David asks, he said, when your momentum was positive, blue, and price made a new low briefly without momentum turning down, turning red, was this a signal that the sideways move was nearing completion and that it might have offered it?
I am so glad you raised that question, because the presentation that I made to you would have suggested that there were only two rules in this trading system, and that is enter on the second candle that is signaling the direction that you think the market's going to go, and then exit on the second signal that's opposite of you. But I've got another piece of this that actually matters to me in my own trading. If I got in on this second signal here, I would have been thinking about a stop at the base of the first signal. And so even though momentum didn't change, I would have gotten out because I'd have been scared that this was an aborted move and that it was reversing fast. And so I would have gotten out if I had gotten in here, so I would have taken a loss on this move. Let's see, if I got in at this peak and out at the stop level, I'd have lost $140 on that trade. And I'd have been sitting there going, ouch. But then I would have seen it come down and come back up. I'd have seen that the oscillator remained in a bullish momentum position. I'd have seen this positive signal, and I would have been primed to go ahead and get in on this signal, saying, all right, I got shaken out, but I'm ready to be back in this, and I might be up 780. So take 140 from 780, and I'm okay.
Tom, are you using the close on the momentum oscillator?
Yes and no. If I'm in a section where the candles are very small and there's just not much action going on, I'm going to wait to near the end of that period to say I've got my signal that I want. When I have a nice move, when I've got some size, I might go in a little bit earlier. Like there's not a good candle here that shows it. Like if I was in a place where I thought we were going to go to the upside, this would have been my first signal, this would be my second signal, I would not have waited to the close on that one to enter. I probably would have got in maybe closer to midway in that. I would have said, yeah, I'm good. And this one would have kept me until I could have made 40 bucks on that trade. And I'm purposefully showing you times when you lose some money or you only make just a little bit of money, because that's the reality of trading in a system like this. That was a great question. Thank you. I hadn't thought
there's some good ones here. A couple others that have come up. Let's see. After wave 5, what levels do you expect to occur in the corrective rally in gold and silver?
Okay. Now wave 5. Do you know which wave 5 we're talking about?
Right now we're on wave 4 when wave 5 is over.
Yes. So let me just pull up, say, the weekly chart, which is the easy way to see that. I've got this projected to, I'm thinking like if wave E topped at 1331, I'd look for at least a move down that is a Fibonacci 618 of wave 1. So I'm projecting wave 5 down to at least 1091, and that's if it doesn't extend, and extending is certainly a possibility. But if, say, we bottomed at 1091, I would look for it to rally back to the previous fourth wave. And so if that happened to be 1331, I would look for it to get to there. But a standard thing for me to do is to put a Fibonacci tool on, and let's see if I can make it click right here at roughly 1091. I frequently am going to look for at least a Fibonacci 38.2% rebound after 5 waves down, and more commonly I'd like to see up a 50% retracement, and it's certainly not out of the question for it to be a 618. So I guess this gives you a target range. The top of wave E, and if that's 1331, that would be a target for me. And then after that, it would be the Fibonacci 38.2%. And I would consider this kind of the minimum upside rebound that I would expect after 5 waves down. But one of the things that is characteristic of the way I work in a market. I'm very impressed by trend followers. I don't think that the market is as impossible to read as a dyed-in-the-wool trend follower is, but I really like the idea of stay with the trend until you've got good evidence that the trend is no longer in progress. And so I can tell you that after 5 waves down, when this market is rallying, I'm not going to be eager to get bearish again. I'm going to want to give that rally an opportunity to reach a top. So, okay, have I done that one to death?
That's good.
Okay.
Okay, I have a clarification on the previous question, though. We were asking about the, is it the close on the oscillator? But he's referring, he thinks he's referring to the oscillator calculation, not your trade entry. Is it based on the close?
You know, the way these things work, and let me bring the chart back up. In real time, you'll see these things change color. Like if we were at a different place, this candle could go from blue to red to blue to red to blue to red several times in the course of whatever period you're looking at. In fact, if I move to a 1-minute chart, we might watch it happen just while we're talking. And so the oscillator is actually set on the close, but the way a charting package works is the close is whatever the current price is. It's not calculated on the close of the last bar, it's on the close of the current bar. And so in real time, yeah, there it happened. See, so now that could go back to blue. Well, we won't just sit here and watch for it, but that's part of why I wait. One, I don't like to trade 1-minute charts because it can change too frequently. I do occasionally trade 5-minute charts. And you can see that you get some decent moves in here. And when I don't have anything else to do with my time, I do sometimes trade 5-minute charts. And of course, the opportunities are smaller, but you know they're not too bad. And if I'd taken the second 5-minute signal here and held it to the second bullish signal there, I'd have made 20 bucks. So, you know, it's possible. You get lucky sometimes. You're on a 5-minute chart and you get a big move in your direction. But with gold and silver, I like the 30-minute charts. I think I answered that question now.
Okay. This one may, I don't know if you'll have time to do this, but someone's wanting to know how you can use Fibonacci retracements to take advantage in a sideways market.
Well, you know, the idea with Fibonacci levels for me, I actually prefer to work with extensions more than retracements. You'll see something that I do very frequently when I get a chance. Like if I have wave A here on my gold chart, I'm going to want to project wave B, and at one point I was actually looking A, thinking I had a B in place, and I was looking up for a wave C. In the case of gold, that's lower than the wave A because A was kind of short and B broke to a new low. And so I might change from just equality to a Fibonacci 1.618 level, which is at 1257, and we actually hit that level. And so you might have used a Fibonacci extension from this low, and you might have decided, well, I'm gonna if it hits 1257.22, I'm coming out, because that's a good 1.618 relationship of C to A using this wave count. And I try to use that as much as possible. But Fibonacci is another one. The problem is in a correction, markets will sometimes do more sideways stuff rather than up and down stuff. And so I'm always worried about the possibility of not getting that far. It certainly happens some, but I don't use it much for a target. What I would do though is I would actually feel better about getting bearish if gold could get up to a Fibonacci 38.2% retracement. when I come in under a standard ordinary Fibonacci level, I feel like, well, that was a shallow retracement. Maybe it's not finished yet. Maybe I'm going to get an X wave down or another ABC down, and then I'm going to get another ABC up. And so the truth of the matter is, I am more likely to feel more aggressive about getting bearish as the market gets deeper into the Fibonacci levels. And I'm less enthusiastic about getting bearish. Like if it topped right here, if we went down through 1249.50 this afternoon, I would not have as much enthusiasm for being bearish as if we got up here to 1261 or 1267. So that's how I would work with that.
Well, we just have a little bit of time here, so let's try to take just two more things. And I don't know if you want to get into this, but do you have any alternate counts that you'd like to point out?
Well, one of the possibilities, I'll talk about it because it's actually a critically important one. If you're looking at a daily chart, this doesn't look like a three-wave decline. It looks like one sharp move. Now, if you look at it like I was looking at it in real time as it developed, you had a pretty distinct A, B, C, and then this triangle. Well, because I know from having looked at this as it was developing on an intraday chart that it was an ABC move, I'm really holding out for an ABC move to the downside here. But maybe, and this is one of the realities of working with waves, it might be that I just need to accept this as A, triangle B, and this is a wave C decline, and wave D is finished at this low, and I'm going to see price move up in wave E without making a new low. So that would be my alternate count, that wave D is actually already finished, and price is not rebounding in wave B of an ongoing wave D decline, that it has bottomed and we're already in wave E. Now my thought is, if price gets up, if it gets up through 1278, I'm going to lose my thoughts that this is a wave B bounce and we're going to get another segment of decline. I'll start looking at this as ABC, wave D is finished, and wave E is in progress. And that matters because if wave E is in progress, we should get back up to the 1300 area and possibly higher. So that's the major alternate count that I'm working with at this time.
Okay, let's just take one more here because I think we're kind of running out of time. Okay. Here's a question. How does your analysis of the precious metals markets correlate with the EWI expectation for a stock market bottom around 2016?
I haven't thought that far in advance. You know, I've frustrated subscribers pretty much from the time I started forecasting anything beyond intraday by not being very, very enthusiastic about my long-term charts. You know, just for an exercise, and I know you're saying we got to think about time. You know, I'm going to go back to the quarterly chart because it's so impressive. You know, you look at this on my ADX study. This was bullish for a very long time, and so if we had used my if we used the ADX study and we'd gotten in on the second quarter of a bullish signal, and we waited for the second bearish signal, we would have captured, what is that, 7,642 ticks. One contract would have generated $76,420 in profit. That's all wonderful, but nobody actually does that. We can project these levels. You know, like I can bring the monthly chart back up, you know, say when we were peaking in that second wave, I could have projected that we were going to get a really big move down through here. But in my experience, nobody actually holds their positions like that because there's so much movement back and forth. And so I just don't think very long term. You know, this wave count has served me since at least August of 2013, and if I had been the analyst earlier than that, this would have been the same wave count because it's the simplest view of the market. 5 waves up, we should get 3 waves down. But I can tell you that if the market starts doing something different and we start rallying again, I'm going to give up on being bearish, even though this is a beautiful count that fits the rules and guidelines of Elliott perfectly. And so honestly, I just haven't thought about 2016. Sorry, I can't help with that.
Well, you're a daily and intraday analyst. That's okay.
Yeah.
Tom, I want to thank you for your time today, and everyone in attendance, I want to thank you for your time. I know we've gone a little longer than we planned, but you had some really great questions, great audience, so thank you. And Tom, thank you.
All right, this was much more fun than I thought it was going to be.
We'll have to do it again.
Okay.
Okay, take care.
All right.
Good night.
Bye-bye.